What is a short squeeze? Nick 22 asking. Okay, give me 1 second. I'm going to go to highshortinterest.com. Okay. So when you short a stock, now we might think that shorting is just the basic idea that we buy a put on a company. That is not actually shorting a company. Buying a put on a company is really buying insurance on the company, because people who buy puts, institutions that buy puts, are buying insurance on very large positions. So think of it this way. Apple stock is currently at 140, and the puts for 130 on October 21st are a little pricey. But if the market crashes and Apple goes from 140 down to 105, a person who purchased a put at 130 has the right but not the obligation to sell that stock at 130 on or before the expiration date of that put option to the person who sold them that put, or at least wherever they acquired the put. Sometimes people sell puts, the put contract is created, somebody closes that position, but it ultimately ends up in the hands of someone else. That's just how the nature of this all works. The reality is, true shorting, what Jim Chanos does, for example, what a lot of people like, I'm trying to think of who other prominent shorts, Muddy Waters. What they're doing is they're borrowing a stock. Okay, so if you're an institution like Vanguard and you own an incredible amount of stock, or you are because it is part of an ETF, or it is part of your broader institutional portfolio, or if you're a bank, a big bank, and you helped engage in the IPO of a company, you may be holding a significant amount of that stock for that process, and you may be holding it for the long term. You may not care at all that a company like CrowdStrike has fallen 18% this year, because what you are going to do if you are a long-term holder is you are going to lease those shares to a short seller. So if I want to short the company, I am going to call that bank and I am going to say, I want to borrow your stock. So let's look at this chart real quick, maybe Beyond Meat, okay? Beyond Meat, one of my least favorite companies in the world, currently up 3% today. And again, heavily shorted. And here you sit right here. Here is Beyond Meat stock year to date. You can see these moves, and I'm going to explain the momentum in part of this in a moment. But if you look at this float and the outstanding shares, the 38% of the stocks are shorted. Now, what does that mean? I borrow Beyond Meat stock from the bank. I sell it out into the market. Let's say I sold Beyond Meat stock. I borrowed the stock from the bank. I sold it into the market for $38. And then the stock tanks. And now, while I am borrowing that stock, I may be paying 3% a month, maybe 10% a month. Who knows? Certain stocks generate certain rental prices. Easiest way to compare it. So let's say that I borrowed it from Goldman in August, and I said, I'm going to short this company for 2 months, and I'm going to pay Goldman 2.5%, 3% to borrow their stock. So I'm paying them 2 to 3% of the value of the stock at this price, $40. And then this sell-off transpires. Right? Citadel, absolutely. And I say, great, the stock has fallen from 38 to 14. I am now going to buy the stock back and then give it back to Goldman. Well, what happened in this situation? Well, I sold the stock at 38. I bought it back at 14. That means I get to keep the $24 in profit this whole move down. Now, here's where the short squeeze comes in. As we said, Right now, 37% of the stock of Beyond Meat stock is being shorted right now. People believe it might go to zero. I firmly believe that as well. But if you are in an environment, for example, March 15th, which coincided with the Federal Reserve announcing that the United States was not going to be in a recession, and the markets rallied. What transpired here was maybe you had people who were shorting the stock, borrowed it up at 59, and they've been shorting it down to 36. Maybe they borrowed it at 33, and it's down here at 35. Maybe they borrowed it at 38, and now it's down here at 36. If the stock moves higher, if they bought this stock, or if they sold the stock into the market in the short move at 38, and the stock goes up to 48, they sold it for 38, they got to buy it back for 48. They've lost $10 per share. So what transpires is if there's a sudden move in the stock or a lot of volume comes in all at once, people are climbing over one another in order to buy back the shares that they sold into the market. And that is what creates a quote-unquote short squeeze. These people are being squeezed out of their positions, their short positions. And if the timing is right, you can see a dramatic reckoning for a lot of shorts. Perfect example of this transpired with GameStop. GameStop was a company in the last few years. Back here in August of 2020, the stock was about $2. And it was so heavily shorted that the short interest was above 100%. How is that possible? It's possible because somebody borrowed the stock from a bank, sold it into the market, or borrowed it from the bank, paying 3%, right, to maybe the bank. And instead of giving it back to the bank, they lent it to somebody else. So you had multiple people borrowing one particular asset from a bank. They're trying to effectively make money on the percentage that they were charging over here. And then also, they're still technically net short on the stock. So what happened with GameStop was a bunch of people on Reddit and other platforms, Wall Street Bets, whatever the financial version of Twitter is. A lot of people got together and said, if we all buy the stock at the same time, well, we'll ultimately short squeeze all of these hedge funds that are shorting GameStop. They'll have to buy the stock. And because it's so heavily shorted, the stock will shoot through the roof because all of these people will be trying to cover their shorts. And the stock legitimately went from $5 all the way up to $120. This was reverse split. I want to say that it went from $4.50, $5 to effectively $780, $800. Scott, you probably know the numbers better than I do. But the point of this was it effectively blew up multiple hedge funds because these guys were just shorting these retail companies thinking they're going to go bankrupt. It's 2020. And then a band of people got together and said, if we all buy the stock all at once, we will force these funds to have to cover their positions. Otherwise, they could experience what is known as margin call. And what would transpire in that situation is if the bank was lending out the stock to somebody, if the bank's lending out the stock and the stock goes from $30 to $700, the bank is going to come knock on the door of the person that they leased the stock to and say, can we get that back right now? We're going to sell it for a profit. So that transpires as well. So if short squeeze transpires where somebody's leasing something, they buy it at 50 and the stock goes up to 80 and the bank bought it at 55, the bank may say, well, we want the stock back. We're going to sell it and we're going to take our profits, which forces another direction that will effectively force some of these funds to trade. I think it hit 600 to 700. And people made a lot of money off of it. And I just could not comprehend what was going on because to me, it was a bankrupt company. All right. So that's a really important lesson. And it's a reminder of this, right? So here's the SPY. And here's what has transpired this year. And it's why when we get a momentum move, positive momentum move, right? Like we saw back here on the 16th of March, it's a good opportunity to trade all of this crap. There's a reason it's being shorted. It could have terrible metrics, could have terrible numbers. ChargePoint was a great example of this for a long time. ChargePoint, until the most recent time the Federal Reserve engaged in its large amounts of speculative capital for EV stations. But look at this. I mean, when momentum has gone positive this year, ChargePoint has ripped. Why? Well, it's one of the most heavily shorted stocks in the market. It may not be anymore, but it was up in the top 20 at one point. Yeah, ChargePoint's effectively been removed, but there still are a lot of companies in that space. Blink Charging's in there. Virgin Galactic's a great short squeeze stock, by the way. And literally, you could just do this and wait for positive momentum. Here is positive momentum, March 16th, 693 up to about $11 in 2 weeks. And that's why, like, we're waiting for that positive momentum to return to this market. Here was July 19th, 722, got you to 833 on Virgin Galactic. And when momentum goes negative, these are the first things you want to short because the squeeze ends. Nobody wants to be holding this stuff. They get out. So company like Beyond Meat, as terrible as this company is, positive momentum event here, March 16th. So you started the day at 38.90. By the end of the week, you were at $52. Positive momentum event was July 19th, 35 up to 38. Momentum stayed positive for the duration. It moved up to 41. And then this is just completely broken down on the backside. This is a zombie company. So if you're looking at these companies and trying to understand why they would be shorted, high levels of debt, high levels of inventory, company like Acromoto is a good example of that. Workhorse, very high inventory, and they're just not profitable companies. I mean, that's one really important thing to keep in mind. I mean, you look at some of the numbers of these companies, the balance sheets are a mess. And, as interest rates rise, Lucid Group, I mean, just another company, it's held up largely on the back of the fact that it is heavily owned by companies like Vanguard, BlackRock, T. Rowe Price. But if you dig into the balance sheet, it's one of the ugliest stocks in the market. It's a great stock to trade. It's a great stock to day trade. It's a great stock to trade for momentum. But as far as investing in this stock, you couldn't get me to do it with your money.